to address some of these challenges, market have developed securitized real estate options, with REITs, REITs being a prominent example. Securitized, what does that mean? Andre, you want to try to answer this? Like, securitized.
Means if anything happen, there is a backup mechanism to still pay out money.
Not really. Okay, securitized just means I'm taking something, making it into a financial product, so I can sell it to others. Right? That just means securitizing. So, for example, student loans, right? Student loans, borrowing mostly from banks, right? Student loan. They can manufacture, design a financial product and trade it in the market. So they will pool all these student loans into a financial product and then just trade it. And they can split into many shares, trade in the market. It could be automobile loans. It could be any other credit card loans. It can even be company account receivables. All these can be securitized as a financial product. So the whole thing about the 2008 financial crisis was that they pool a lot of mortgages into like all the subprime mortgages, right? Right, into one securitized product, and they sell it. So what they think at the time was that the default of one property is high, but if I spread it out into many properties, it's lower, right?
Oh, okay.
Because the chances of one property defaulting, assuming it will not affect other properties. So what they're trying to achieve is, if I securitize it as a financial product, the overall interest could be lower, right? You're spreading out the risk. You put it in different tranches, which means that the person that is borrowing can have a lower mortgage rate as well.
So it's like packaging it up.
Yeah, exactly.
In a
Yeah,
certain
it's,
way that is of what you want it to be.
you can think of it as using the word packaging. But during the financial crisis, what they didn't anticipate accurately is there's a systemic risk. So what happened is, okay, if one mortgage goes bust, assuming if it's a normal situation, it will not affect the other property, right? But if it's during a crisis, if it's like a chain effect, all of them go bust at the same time, then there is no longer independent, and all the correlation will go to one, and all of them will go bankrupt at the same time, right? We're talking about banks are going bankrupt because, once it has a chain effect, one bank will cause another bank, and all of them will start to all fail at the same time. So that's what happened to the 2008 financial crisis. Okay, anyway, back to the REITs. For a publicly traded equity investment avenue in real estate, often managed by professional property managers. So from the get-go, it's already property managers are all there, all securitized into the financial product. And investing in REIT shares offers exposure to a diversified real estate portfolios. These shares are typically liquid with active trading facilitating prices more reflective of market value, because it's actively traded in the market price. And the main focus is diversified. So you don't have to worry about, because most REIT consists of many properties, right? It's not just only one particular property. So that's one good thing about REIT. And another thing is also, for most people, they have no access to commercial properties, but through REIT, you're able to have access to commercial property. I mean, just imagine how many people you need to pool in order to buy a shopping mall or office building, right? That'll be hard to imagine.
Is REIT always gone through a private company? Like, okay, let's say.
No, it could be a public company, but it has to be a company.
So let's say
Real estate company.
I'm interested to have REIT investment. I can only go through as a financial product from a certain company.
Yes.
Right?
Yeah.
Okay.
Similar to the earlier session with Kenneth podcast next week, basically, I will show him some examples of bonds, like real life bonds from companies. Then we will go through them together, right? So for REIT, we'll do the same thing as well. So in the next session, we will show real examples of REITs and some of the price and some information that we covered today. But today we will just give a rough idea, and then we will show more next week.
Yeah, sure.
Actually, there are a lot of things that we need to cover. So, okay. So there are various types of real estate properties, typically classified into residential, non-residential categories. So this is the two broad categories. Within residential properties, distinctions can be made between single-family houses and multi-family units. So from I think this is from a US perspective. We have like houses and apartments. Apartments are known as multi-family units. So these are all residential. Okay, residential properties primarily offer housing for individuals and families, whether owner occupied or rented out. I think in a Singapore context, most of the time it's owner occupied, but I believe in most countries, that might not be the case, right? Anyway, let's move to the next. And for non-residential properties, encompass commercial real estate. This is the one that we will focus more in the future. Farmland and timberland. And so, Andre, in Australia, probably you have a lot of farmland, right? And I know in Canada, they will have a lot of timberland.
In Australia, call it rural.
But that will be the farmland, right?
Yeah, it's more of farmland. I'm not sure what's timberland.
Lumbering. Okay,
forest.
Yeah, like you own the forests, so you can do forestry. Commercial real estate, the focus here is the largest investment class and is categorized by end use. This includes office, industrial, warehouse, retail, and hospitality properties. So hospitality is like hotels and stuff like that, right?
Yep.
Hospital is not in hospitality, right?
No,
Yeah.
Hospitality is more of hotels, accommodations. This kind.
Yeah, I know. I'm just thinking whether a hospital in REIT, probably not.
I
There are, I think we might be, right?
might be. I think I don't know, because generally a hospital organization, if they want hospital, they don't rent it from the real estate agent or anything. They will just build it themselves.
No, I know. But then if you want to,
So
in terms of having shareholders, in terms of the equity, right? So because if not, then one entity could be a company, or I mean, what cases it's probably the government, or it could be a privately owned hospital. But at the end of the day, there's always a company or government behind it that is funding all these, or they might be borrowing. But there's one entity that is responsible for the procurement of the whole property. So what we're trying to, for the public traded part, is that the fact is that you can get the government fund and fund the hospital. We can do it in such a way that we can securitize it, and we can let people invest, right, and to pay for it. It's like the way the reason why we have all these different ways of securitizing, so they open up for more investors to come in. So you don't have to have like constraint to a specific, and other people can also have a share of these potential investment, right? If not, it will be close to them. So all this
is the versatility of all these operation is not so fluid.
Which is why securitizing makes it fluid.
Yeah. But for this office, industrial, warehouse, retail, hospitality, they can come in and out anytime, because there are many operators out there for all these sectors to come in anytime. But for healthcare, it's not that fluid, because you usually a hospital is more of a government kind of objective. So
but they're privately run hospital.
Yeah, but
anyway,
like if they come out, who's going to take over the building, because it's such a specialized building?
No, in terms of, okay, if you are the owner, in terms of publicly traded, right? I mean, there will be a trustee, somebody that will actually run the place, but you have to pay the person money. You do the work, purely from being paid to do it, right? Often, properties may serve multiple purposes. For instance, a building may contain both office and retail spaces, or even a mix of residential and non-residential uses, right? Termed as mixed-use developments. Okay, this is self-explanatory. This classification aid in analyzing supply, demand, and economic performance for each type of space. Okay, this is more for the valuation part. Risk factors. The risk and return characteristics of equity real estate investments are influenced by the unique features of real estate associated risk factors. Okay, the unique features we have been talking about heterogeneity part, okay. Leasing arrangement between owners and tenants play a significant role in shaping risk and return dynamics. Leases can be likened to bonds as they entail regular payments from tenants to owners. So this is probably talking about like long-term lease. For bonds, the interest rate is fixed. You get paid if you are a bondholder, you get paid a fixed interest. Of course, there's a floating interest, but to simplify things, we just talk about fixed interest. But if you sign a long-term lease, you lock in the lease. Basically, the rent will be locked in. So there is a similarity in terms of like long-term stability and commitment to it, which I think for commercial, especially for commercial, this lease part is very relevant. I think for residential, you're not going to lease like 10 years or something, right, to somebody for residential. But I think for commercial, it's quite common for like very long-term lease.
Yeah, because they have income.
Business. Okay. However, uncertainties arise at the end of these terms. For bonds, you don't have this issue, right? That will be like end of the maturity. But if it's a 10-year, 30-year bond, the interest is always fixed. Regarding lease renewal and rental rates, influenced by factors such as market competition and economic condition, akin to stock market dynamics. So what this is trying to say is that at the end of the day, real estate is somewhere between bonds and stock. It's what that's trying to imply here. Consequently, real estate exhibits a risk-return profile that falls between stock and bonds, right? Considering both bond-like stability, that's the fixed cash flow part, which is the lease part, and stock-like variability, which is the part that you have no control on in terms of what happens after the lease ends, or if you cannot find any tenants, or in terms of the market, then like nobody is going to rent from you. While individual real estate investment may deviate in risk from individual stock and bonds, the aggregate risk and return characteristics of the real estate portfolio typically lie. And yeah, this is basically in terms of risk and return. So it's important to note that we're talking about both risk and return. And normally, you would think the higher the risk, the higher the return, but also the higher the loss as well, which is the risk part. Commercial real estate, okay, this is the part that this will be mainly focused for the CFA curriculum. Institutional investors commonly include core property types: office, industrial, warehouse, retail, and multifamily apartment in their portfolios for their relatively low risk nature, assuming favorable location and strong leasing fundamentals. Institutional investors just means like hedge funds, pension funds. You know what are funds, right? Like hedge funds and pension funds. For example, pension funds for those investment funds that invest your pension. So they will you pay them regular premium and they'll take care of your pension for you, right? Because their liability is very far in the future when they retire. So in the meantime, they can build their return and portfolio so that you can meet the requirement for your pension in the future. So what they will do is they will invest in multiple. They will try to diversify their investment. The thing that they would be interested in would be like commercial properties, right? Because of the attributes of having low risk nature. I mean, assuming if it's a favorable location and strong leasing and fundamentals are basically you can assign a longer term lease. Hospitality properties such as hotels present higher risk due to the lack of leases and susceptibility to business cycle fluctuations, particularly if reliant on conventional business. So basically, it's people not booking hotels when times are rough. In terms of, for all these that are longer term, because you sign a contract for longer term, it's less of a concern, but it's still, of course, a worry due to business cycle. But it's a bit lower risk compared to hospitality.
Yep.
And location plays a pivotal role across all property types. Prime location, the business district, with modern amenities command the highest value per unit of space, while properties in inadequate but not prime locations, slightly outdated features. Yeah, all these are pretty intuitive.
But this statement may also change over time. Like how this is assessed in terms of location might be what everyone have known to be a good location for the past many years, but the
Reflecting the price,
yeah, but
which
the
is your property
information
value.
that you may have may play a very important part. Like for example, property on a low on a poor location, it may not be poor as long as you know that it's going to be developed in the next 10 years, 20 years, what will happen, this kind of thing. That the government may want it to be developed to make it more booming.
Yeah, but that is another component in assessing the portfolio value. But this section is just trying to say that location affects the value. But
Yep.
what you're trying to say is that it's not just the location, if you don't see other factors as well. But all these various factors will affect the value. But anyway, okay, this is the part that comes to the valuation, which is more in tune with the adjacent investing. Is okay, due to infrequent transactions and the unique nature of each property, commercial real estate properties rely on estimates of values or appraisals instead of transaction prices to assess changes in value. Okay, this part we have emphasized a lot, and in subsequent podcasts, we're going to actually cover how they do the appraisal. And appraisals are typically conducted by individuals possessing recognized expertise in the field, as independent experts hired specifically for the task or in-house professional. Yeah, this is self-explanatory. Appraisal, this is valuation. Essential by assessing the value of real estate properties are particularly crucial due to the infrequent trading and unique nature. Okay. Unlike public traders, such as stocks and bonds, which have frequent transactions, reflecting current investor valuation, commercial may only trade once every several years. So the frequent transaction for stock and bonds is, depending on the volume, is definitely multiple times a day, right? Even in even in like 1 minute, it has a lot of transactions, which is why, because there's so many transactions going on, it's being valued all the time, right? So which is like people are constantly spending effort to value the place.
Yep.
Yeah, but in terms of property, not so much, because it doesn't change hands that often. But REIT is being constantly transacted, so this is the same like any other stock. And while monitoring share prices, it provides insight into real estate market condition, but it doesn't replace the need for individual property valuation. So in the sense, this is trying to say that REITs can help you to value. It could be properties that are similar to whatever is in the REITs. You can use that as a reference, or you just want to purchase that one property from the REITs. Then the REITs, because the REITs probably consider multiple properties, right? It's a reference point for you to determine the price. Anyway, this is just saying that how important appraisal it is to establish property value, which I need to emphasize multiple times, that we will cover that eventually in this podcast. Okay, particularly if financing is involved, this is the interest rate part, because lenders typically require independent to estimate the collateral values for loans. Oh, okay, so what this part is trying to say is that a lot of time people use properties as collateral for loan from banks, and the banks, in order to they need to know the value of the property in order to determine how much to lend to you. If you're taking a mortgage from a bank, your property is automatically a collateral. Yeah, you don't even own the property. I think the bank is holding the title deed until you repay the loan. When we talk about valuation approaches, you know what it's trying to say here, right? It's just to determine the price of the property,
Yep.
right? So there's three methods that usually you can do. Is one is income approach, cost approach, and sales comparison. Income approach is the one that the CFA curriculum will go into detail, because this goes into cash flow discounting. It evaluate what an investor will be willing to pay based on expected rate of return. This is the discounting rate appropriate for the investment risk. Actually, this is how you value a stock as well, even a bond. The estimated value is essentially the present value of the property expected future income, including proceeds from its eventual resale. So this is the future sale price. So this is basically the 10 value of money that I'll cover in the future. And the idea is that the value depends on the expected return rate. This is a required return investor will require for the property. This will be covered in depth in the future. For the cost approach, this is more straightforward. It's just the cost of purchasing the land and constructing a new property, the same utility as the one being appraisal. Adjustments are made for the age, design, feasibility of new construction, and location of the subject property. The concept here is that one should not pay more for property than it will cost to buy vacant land and build a comparable property. I would reckon this is the book value of the company, but this one doesn't actually factor into the future utility of the property, right? I would think.
Yeah, and I mean, for this and the next one, that's the sales comparison, I'm thinking more of the cost of materials as well. They are very different. The cost of building something using
No, but sales comparison looks at similar properties that have been sold in the current market, right? So whatever the price that you sold in the current market, I think this one is more for the Singapore HDB equivalent, right? We always look at what is the similar transacted property recently. So because this is based on recent market price, so this one, whenever you deal with market price, it always factors what is going to happen in the future. So this income approach is trying to determine what's happening in the future, and you discount it back, because in the future, like the future rental income or future expected appreciation based on like what you described earlier. It could be a new development in the area. All this will be factored into the market price, right? But if there's no market price, the income approach would factor that in. This would, based on modeling, what you think will happen in the future. So this is a part but for the cost approach, I think it's more in terms of book value, which is like how you sell the equipment, your office equipment. But this is probably the least accurate version. Yeah.
Yep.
Okay. So the principle is property should not be valued higher than what others are paying for similar properties. Does that make sense?
I think for example, Singapore HDB is more uniform and typical, because each HDB, I mean, obviously take the location aside, but all HDBs is not so
too
much
different,
like apartments where all people buy because this apartment looks better, this apartment has swimming pool, better facilities, etc.
But even apartments with swimming pool and everything, like there's also a lot of transaction that it's not rare, right? You still find, like, I mean, in terms of an apartment which has many units, there will be bound to have other units that have been recently transacted. I mean, there'll be cases that there might not be any, but I think for the income approach, it's more for those kind of properties that you really don't have any recently similar property. their recent sale. In fact, I think for the income approach, it's more applicable for properties that you cannot even find another similar property.
Yeah.
Right? Because you're talking about commercial, it could be like a mall. You don't have another similar one.
Yep.
The heterogeneity works in this for this income approach. The sales one are more for things that are more. You see this part, similar properties, right? Yeah. So yeah. So I mean, I'm talking about this more in terms for those people who are taking the CFA exams, right? In order for them to remember, what is actually the distinguishing difference getting in terms of this, which is why this podcast is trying to help people by giving you intuitive understanding for the exam. Okay.
Yep.
Okay, highest and best use. Okay, I think in this one it might be something new for you. Highest and best use of a vacant site refers to the use that maximizes the land's value. Example, right? For example, considering determining the highest and best use for vacant land with three potential users: apartment, office, and retail. So you have a piece of land and you want to sell it. So who would actually bid for the land? So all three of them users comply with zoning regulation and are financially feasible if the land value is appropriate. Additionally, the site physical characteristics support construction for each of these users. What this is trying to say is that this piece of land can be used for these three purposes, but who will eventually successfully bid for this land? So value after construction is these figures. Cost to construct is figures, and implied land value is these numbers. So what this is trying to say is that for apartment, the developers would bid the land for 500,000, like around that value, right? I mean around each lah. Or maybe you can in terms of the highest bid. An office will bid 200,000, and this will be like 1 million. So eventually, the retail will be able to bid for it because it's able to offer a higher price. Of course, if the retail can have a lower bid, of course they will have a lower bid, but they can pay up to $1 million. Is what they are trying to say here. And what this is trying to tell you is that it's not the one that has a higher value will have the highest bid, right? Because the retail after adjusting the cost, it actually has a higher implied land value. Showing the inner working of actually why certain area has a need for will be based on what. It's part of the reason could be this. I mean, because we already account for the zoning regulation. If you guys enjoy this video, please like and subscribe to Jason Investing YouTube channel, and we will see you next week. All right.
Thanks, Jason. Thanks, everyone.
Thanks, Andre. Thanks, everyone. Bye.
Bye.